Imagine it's 30 years from now. You, your kids, and your grandkids are all on the beach. Your only worry in life is making sure that everyone has sunscreen on and they're applying it every hour on the hour. That sounds like a lovely future, but 30 years is a long time away. Don't worry, there is a way to get to that beach faster than 3 decades. But remember, there is no such thing as a free lunch. But I think you might find that what you have to do is completely worth it. The reality is that retirement looks a lot different for everyone, but I would suspect that we all want to be at least financially secure, and of course not have to worry about where our money's coming from, whether that's 5, 10, 15, 20, or 30 years from now. In my lifetime alone, I've seen the market take deep dives more than once. First, it was the tech bubble bursting, then it was the housing crisis and following recession, and right now the markets are going through record inflation, a looming debt crisis, high interest rates, and of course, major banks failing. It's no surprise investors are looking for a safe place to put their money. One of those places is dividend stocks and ETFs. The stock market, specifically the S&P 500, has a history of going up in value over time. Because the ETF SCHD has an investment strategy based on the Dow Jones 100, or stocks that have a history of paying high dividends consistently, I think the ETF will go up in value right alongside the market. So if we set up our investments in the right accounts, we'll be able to live off of those dividends in retirement and be able to pass that investment on to our kids to build generational wealth. 3 decades from now, I'm planning on being a full-time grandpa. There's no time to worry about the markets with that kind of responsibility, and I don't want my kids to have to worry about money so much in the future. I don't think I'm the only person that thinks this way, which is why I believe the ETF SCHD is so popular. It has price appreciation, a growing dividend, and has outperformed the S&P 500 since inception, which includes this current very difficult economic time period. I fully believe these hard times in the market will happen again in the future, and I think SCHD is going to be seen as a safe haven during those times as well. This is what I want at the foundation of my finances, because when the market is up, everything is fine, but when the market is down, I want to know me and my family are financially secure. Let's find out how much it would take to live off of SCHD in 30 years if we started investing today. And then we'll go over how we can cut those years down dramatically. Then we'll talk about how we can set these investments up so that way our kids can inherit the asset. Now, cost of living can vary wildly, but for our example, we use $50,000 a year. SCHD has a current dividend yield of 3.8% and is currently trading around $72. Now that we have all the numbers we need, let's do the math. $50,000 divided by 3.8% expressed as a decimal gives you close to $1.3 million, which at a price of $72 per share gives you roughly 18,274 shares of SCHD to make $50,000 a year in dividend income. Now I know $1.3 million sounds very unrealistic, but remember, we don't need that today. We have years before retirement, and thanks to the 8th wonder of the world, compound interest, this is actually an attainable number for most people working a 9-to-5 job. Let me explain. There's 2 ways to build up to that $1.3 million. The first way uses a lump sum of $10,000 with consistent monthly investments of $350 and dividend reinvestments. This calculation is also assuming an average yearly return of 12%, which is based on SCHD's past performance. Now, if you did that for 30 years, you'd end up with a position around $1.36 million. And the cool thing is that you only invested $154,000 of your own money over that time period. The other way of doing this involves a lump sum of $45,000. In this strategy, we're going to also reinvest the dividends, but there is no monthly contribution. Waiting 30 years, assuming a 12% annual return, you'd end up with $1.3 million as well. Now I know not everyone has $10,000 or even $45,000 in cash just lying around, but people do save up for large down payments on homes regularly. And I believe that if more people knew about SCHD, ETFs, and lump sum investing, more people might be encouraged to save up large down payments for investments in addition to houses. The crazy thing about these calculations is that we ended up with the same amount of money over the course of 30 years, but in the lump sum and wait strategy, we invested about 1/3 of the money, which then begs the question, is that shiny new Tesla worth it? Now, of course, these calculations are all based on assumptions. One of them is consistent investing, one of them is dividend reinvestments, and this math doesn't take into consideration fees and taxes. And obviously, a 12% return and a 3.8% dividend yield are critical to these numbers, so if they change, so will the numbers. And SCHD has only been around for so many years, so we don't have a long history compared to something like the S&P 500 that we can use for better predictions. We also need to keep in mind that SCHD pays a quarterly dividend based on how many shares you own. So if you're dollar cost averaging the same amount every month and SCHD goes up in value, you're getting less shares for your dollar. But the real magic behind SCHD is compound interest. SCHD typically has an increasing dividend, which means the money that you get for owning it is going up in value. So if you're continuing to reinvest those dividends, this can help offset price increases and help you maximize when the price goes down. So the math checks out, but how do we live off of our dividends in SCHD sooner than 30 years? Well, one possibility is that SCHD is going to go up in value over time. I think it'll get more popular as we talk about it more, as more people find out about it, and that could lead to higher prices, but that's not really realistic. There is something else investors can do. Let's run the numbers again, but this time, let's say we invest $400 a month. We end up with $1.5 million after 30 years and hit $1.3 million a full year sooner. And if we invested $5,000 more in our one lump sum strategy for an even $50,000, we get a very similar result, hitting $1.5 million after 30 years and hitting $1.3 million about a year sooner. Running the numbers even more, we can see that if we increase our monthly contribution to $1,000 a month, we get to $1.3 million in just under 22 years. And if we increase our lump sum investment to $100,000, we get to $1.3 million again between 22 and 23 years. So we're shaving 8 years off just by putting more money in. In short, as long as the asset performs and the more money we put in, the sooner we get to our financial goal. I wanted to bring this up because there are so many temptations for us to spend our money, and there seems to be an endless option for new investments that we could put our money into, some of which may or may not be worth the risk. But if we have a financial goal, we're more likely to get there, and if we know the potential of SCHD, we're more likely to invest into SCHD as our go-to investment and not get tempted by shiny things in the market. Of course, returns are never guaranteed and no one knows what the future holds. But the good news is that history seems to be on our side if we're betting on the US markets. I'll leave the calculators in the description below so you can run your own numbers for your own investments. No investor should go in knowing nothing about their investments, so I'm going to give you a quick rundown of SCHD. It's an ETF that tracks the Dow Jones 100, which focuses on high-paying dividend stocks with a history of consistently paying them. It was created in 2011, and since then it's outperformed the S&P 500, assuming your dividends were reinvested. Its top holdings change every so often, but currently consists of some household names like Pepsi, Coca-Cola, Home Depot, and many others. It has an expense ratio of 0.6% and a dividend that is usually above 3%. So the main reasons why I'm choosing to invest in SCHD are as follows. Number one is that it has a low expense ratio compared to other ETFs. Fees are something that are going to eat into my profits, and I want to make sure that I'm paying the lowest amount possible. Number two is that it has a reasonable dividend. SCHD isn't promising a 10 or 15 or 20% yield, which means that I know it doesn't have to take unnecessary risks in the marketplace with my money. I'm okay with less yield for a safer investment. And number three is risk management. SCHD seems to have performed well in the past couple of years given the market volatility and downturn. I can't argue with results in a difficult economic environment. And number four, it seems to be giving us the best of both worlds in terms of growth and dividend yield. Number five, it's trading at a low price compared to 2021 highs, which means that I see this as a huge value play. And number six, favorable tax treatment. Because SCHD invests in dividend stocks, once you own the shares for a long enough period of time, the dividends you receive count as qualified dividends, which saves you money during tax season. Compare this to some covered call ETFs and real estate investment trusts, this is not the case. Another way to maximize this ETF for you and your future generations is to use a Roth IRA. A Roth IRA is a type of investment account where you take money that's already been taxed and fund the account. You then invest that money and it grows tax-free, with some exceptions and limitations, of course. So read the fine print. Now, in the case of passing on your wealth, there's something called an eligible beneficiary, which means that when it's time to transfer the funds to your heirs, they have 10 years to drain the account, which means that they could let it sit there for 10 years and then take it all out at once to allow the position to compound even more. Now, I'm sure there are rules and exceptions to this as well, so make sure you work with a tax expert on it. And one huge reason why I love this strategy is because it's a lot easier to invest in an asset like a stock or an ETF. Compared to a business or real estate, there's very little maintenance with this kind of asset, which makes things easier for your loved ones. Hopefully this video was motivating for you, and I want to say thank you for watching. I appreciate your time here. If you found value in the video, go ahead and click that like button, subscribe for more money, finance, and crypto content, and make sure you work with a professional, as I'm not a financial advisor, so you can help meet your financial goals. Thanks for watching. See you next one.